Hey, this is James Dainard, Heaton Dainard Real Estate. We have a few more people kind of logging on, and then we're going to get going about 5 after, so in 2 minutes. And then we'll get going on the presentation. Thank you. All right, thanks for everyone for signing on and taking the lunch hour to kind of hang out with us and get you some information on 2018 and what we're kind of forecasting for 2019. We're going to get going on this pretty quickly because we have a lot of stuff to cover. So first things first, for everyone who's logging on for the first time, thanks for logging on. If you can also go to our website at heatondainard.com and also download any other educational webinars that we've produced in the last couple months. We have one on construction costs and controlling them and setting up your budget. It's a 4-part series to kind of give investors helps and tools. We're going to be doing more of these throughout 2019. Our goal is to just get you guys free education to help you with your investments. So if you have any questions or, feel free to go to the website and download those. You can share them with whoever you like. So for people that don't know me, my name is James Dainard. I've been an active real estate investor since 2006. Me and my partner, Will Heaton, have flipped over 500 homes in Kingstone, which is in Pierce County. So we're very active investors over the past 12 years. We've been purchasing flip properties and multifamily and buying holds in pretty much every kind of market, from the hot market in 2005 to the crash in 2008 till the kind of craziness we got going on right now. As a real estate broker, our team has helped investors design and sell over 1,300 listings for investors in the past 8 years. We're one of the highest volume real estate brokerage teams that kind of specializes in selling investors' product on the open market. And in 2018, this past year, even with the kind of market settling down, we've managed to sell over 180 investment properties for our clients, totaling over 100 million in sales. So if you don't know who we are, come check us out at our fix and flip cash flow class, and we'd be happy to sit down and talk to you about your investment strategy. So as we kind of dig into this, what we're going to cover, what we're going to cover is we're going to recap 2018, which talk about kind of appreciation, current inventory levels, what they were at in the first couple quarters, the last 2 quarters of the year, because that's kind of what we're focusing most on right now. The reason being is because that's kind of our most accurate data. Also, we're going to talk about the construction cost increase in 2018. It's been a very big struggle for all of us. And then what impact interest rates have had on our investments and on potential home buyers of our investments. After we kind of recap 2018, we're going to forecast 2019 a little bit more out, which what we're anticipating for appreciation, what we're also anticipating for market times as we kind of get ready to sell our clients' investments and our own. what we're anticipating for construction costs, because we see them coming down, so that's all good news. And then the interest rate raise schedule, which, I think all of us are kind of keeping our eyes on. And then from there, after we're kind of done forecasting 19, we're going to talk a little bit about how us as investors are going to be purchasing in 2019, and what we're suggesting to our clients as we see as kind of new shifting investments, and where the best place to kind of stick your money in, which is going to be in flips, buy and holds, and long-term wealth, development sites, and then also any kind of syndication investing that our investors are starting to kind of go towards as well. So we're going to dive right into it and jump into what happened in 2018. We've had a lot of good things and a lot of bad things toward the end happen, and we're going to kind of recap those. To kind of just go over the stats and facts, like how did the year end up? The year ended up very, very well for all of us. In King County, the average days on market was 24 days closing out the year. The average appreciation year over year was 10% ending from 2017. Median home price is up to $660,000. And current month of supply, or the average month of supply, was 1.43 months. Pierce County, the average days on market was 25. Average appreciation was a whopping 12.9%, and the median home price raised up to $336,000, with current month of supply, or the average month of supply, is at 1.26 of houses in inventory right now. Snohomish County wrapped up with 24 days on market, an average appreciation of 12.4%, and a median home price of $475,000. And a month of supply, this is 13.1, but I actually think it's 1.31%, or 1.3 months weekly supply in the market. So what does all this mean? It means that we are in a very good market, guys. It's the year wrapped up very well. I mean, a normalized market is around 5 to 6 months. We're going to talk about that in a second. So the fact that our average month supply is at 1.43 in King County, that is a very, very low. What that also means is there's less homes for sale than there are buyers in the market. So, things are still looking very good for 2019. One thing that we want to talk about, because, I think with the last 2 quarters and a little bit of a market kind of correction and kind of getting back into a more normalized market, we want to kind of educate people on what is a normalized market. We've had this crazy hot 2 years of appreciation and rapid home price growth that, I think a lot of us have forgot about what it really means to be a true real estate investor and being in a normal condition. So a normal market, by definition, is 4 to 6 months of supply of inventory. That means that 4 to 6 months of supply of inventory is considered a balanced market. So right now what we're in is, with our current month supply below 2, we're actually still in a heavily based sellers market. There's still half the amount of inventory that is available compared to a balanced market. Supply typically goes, when supply dips below 4 months of inventory, that's when we tend to see all the appreciation in the market. When supplies go above 6 months, that's where we actually start to see depreciation. So we are a heavy supply, or we are way below a heavy supply of homes at 6 months. So right now we're still anticipating some appreciation in 2019. One other thing that we kind of want to point out is, we look at historical averages. We're big believers in 10-year cycles and just looking at the historical data points of all investing, whether it's a stock market or real estate market. And one thing that we want to always point out is, the average appreciation, and this goes back to the 1950s, has always been around 4 to 5%. Okay, the only time that has not happened is actually from 2007 to 2011 because of the huge market crash. So, in the recession. So we're anticipating, because we're still in a below normal supply, that we're still going to see about 4 to 5% in anticipation over the year. So that's going to be about a half point per month. So, I think in the beginning of the year, a lot of us were seeing 10% jumps in a single month, which is just a little bit unreasonable. And so, what we need to do is anticipate what historical averages are. So again, a balanced market is, 4 to 6 months worth of supply and inventory. We're well below that. And, if we're below that, we should anticipate 5% growth in all of our investments on holdings or flips. So what we're going to talk about next is transitioning from a peak market, a crazy hot sizzling market that we've been seeing, to a good market. Because right now, we've heard a lot of chatter from clients, and just, we see a lot of bad press coming out that the sky is falling and inventory has doubled and all these things. But we are still in a very heavily seller market. So we really want to focus on the first 2 quarters and the last 2 quarters of 2018. So the first 2 quarters were incredible for all of us, right? If you were a seller at the time, if you wanted to be a seller at any time in the market, this was the time. So in King County, in the first 2 quarters, the percentage of list was 102.7% of all homes in King County. So that means that every home was getting bid up on average for at least 2% above list. Inventory levels were actually less than 1 month supply. They were about 0.7 month supply in the market. So that is ridiculously low. And the average days on market was 20 days. Interest rates during this time was 4.4%. One thing also is that was the current rates, but a lot of buyers in that first quarter had rate locks around 4% that they kind of rolled over into the first part of the quarter. The first 2 quarters for Pierce County was very similar to King. Percentage over list was 90. That all properties sold at 99.6% of list price. Inventory levels were below 1 month, and average days on markets was 29. Interest rate again during this time was 4.4% or 4% if they locked in earlier or at the end of 2017. The first 2 quarters in Pierce, excuse me, guys, I think the last one was actually Snohomish County. The last one, the first 2 quarters in Pierce, this makes a little bit more sense. Pierce County had a very good appreciating year in 2018. Listings sold for 102% of list, and the average inventory levels was less than a month, and days on market was at 23 days. So as we transition into the last 2 quarters, right around July, we start to see a market correction going on. Part of this is because rates stuck and people's rate locks expired, and rates crept up to 4.7%, which may not seem like a lot, but when you're dealing with a lot of rate lock buyers at 4% and now the sudden increase to 4.7, it can, along with a summer cool down, which always happens in every market, it caused us to create a correction, and buyers are starting to push back. Most of that pushback is just based on affordability and inventory. So in the last 2 quarters, King County was down from 102% to 97.6% of list price. Pierce County percentage of list price went from 102% down to 97.9%. And then Snohomish County went from 99% down to 97.1%. So you guys, these aren't huge corrections based on brokers pricing homes correctly or sellers pricing homes correctly. What that's saying is, statistically in the last 2 quarters that all listings were selling for about 2% less than their anticipated list price, which is not that big of a correction, considering a lot of homes actually were just been overpriced in that last 2 quarters. Inventory levels pretty much across the board have all crept up to about 2 months on average. So 2 months is at 50% of what people considered a balanced market. So right now we are still 50% below a balanced market. But the reason we had that sudden kind of jolt in the market is we had the interest rates rise, which affects the payments, and then inventories are still at 2 months, which is very healthy. But inventory, when you go from 0.8 to 2 months, that's double the amount of inventory in the market. So anytime you take any kind of investment and you double the availability of it, there's going to be a jolt back. And that's what we saw in the summertime and in this fall. And so what that's creating is just longer days on market. The average went up from 20 to 28. And actually, Snohomish County has stayed pretty strong at 30 days in general. And the reason being is there's a lot of rural property out there, so they take longer to sell in general. And then Pierce County ticked up 4 days from 23 to 27. So with, more inventory, even if it's at half of what it was, it's going to create longer market times. And, investors need to anticipate those longer market times And, on average, if you're selling your investment in about 30 days, that's still really good. Back in 2015, when the market was good, but not as hot as it was now, it used to take us 2 to 3 months to get a home pending during that time. So we just need to anticipate more normalized market times. So as we kind of recap 2018, most importantly, as we kind of saw what happened, the best thing that we can do as investors is take this information and implement it into our strategy. We're going to talk about 2019 and what we think is going to happen in the market. First thing we're going to talk about is listed properties and, or being a seller in this market. So, we're all, not only a broker do we represent a lot of sellers throughout the year, we're also sellers ourselves. So as a seller and investor myself, one thing I've realized in about July is the market is going back to a normal condition, and that buyers, buyers have more time to decide and double the amount of inventory, even if it's half of what a good market is, to make that choice. In the spring, when inventories were getting close to a half month of supply in some neighborhoods or very little at all, buyers didn't really have a choice. If they wanted to live in a specific area, they had to take whatever was out there. So now, even with the sudden increase in inventory, buyers can take their time to decide, and they want to take their time to decide. It's not really normal for a buyer to walk into a house for 20 minutes and write a no contingent 10% over list offer just to get a house or a roof over their head. So we're going back to a more normalized market, and we just need to anticipate that our listings are going to take a little bit longer to sell. What we have found in this market, if you're pricing a home at a reasonable price that's very well taken care of and updated in a very good fashion, where you're hitting all the mechanicals that the buyer's wanting, they're selling very quickly still. On average, we're getting those pending at about 14 to 17 days, which is below the 30-day average in Keene County. But you need to price them correctly and make sure that your asset is in tip-top shape. One thing that we also have to anticipate more, which does affect our net profit at the end of the day, is anticipate more contingencies on your offers. In the last 2 years, we saw very little contingent offers come in whatsoever, because honestly, we wouldn't take them. There would be no purpose in taking a contingent offer. Right now, as a lot of buyers are trying to upgrade their living space, we're seeing, I've seen at least 20%, or no, actually, I've seen about in the third quarter, we saw a good uptick in contingent offers. In the last quarter, we probably saw about double the amount of contingent offers on our listings as the third quarter. So, what we need to do is just anticipate, a contingent offer, as long as you're qualifying their asset they're selling and they're pricing it correctly, they're not a bad way to go with. Just really want to qualify those people, and then also anticipate longer hold times with your hard money or carrying costs. Also, with your contingencies, buyers are going to leave their inspections in most of the time now. So you really want to make sure that your house is very punched out and you don't put yourself behind the 8 ball and negotiate a really big inspection response. Because buyers have more inventory, have more time, it allows them to beat you up more on the home, and to make, they're going to want more things upgraded or more, they want a very turnkey home. So they're going to expect you to do those things. Those things cost money, which affects your bottom line. More inventory, as the inventory is at 2 months now, that's going to slow the sudden market appreciation. In the spring, anybody selling a home, including myself, had this huge market, benefit by inventory being at half the levels, or a half month supply. This caused some of us to get 10% jumps in appreciation in a 30-day window on our investments, which proved to us that they were very, very profitable. We should anticipate less of that going on. I would anticipate steady growth. And, as we get more towards a balanced market, you guys just want to, it's more based on the fix and flip properties and buy and holds are more based on execution rather than a market appreciation. And then one thing that you want to pay attention to right now is buyer pools have shrunk. Okay. There's a ton of variables that are affecting our buyer pools right now coming by to buy our assets. One is affordability. Interest rates have increased and people can't qualify for the same amount of purchasing power. And then also, locally where we've seen some impact is the stock market volatility. A lot of our buyers, especially in Seattle and, some core areas in Pierce County, they are tech people. Their tech stocks have gone up at a dramatic rate over the last 12 months. Sometimes they've gone up, anywhere between 30 and 70%. That's 30 to 70% in stock options for a lot of these buyers, which they could then roll into the down payment on these house prices. With the stock market coming back on pricing, what that's doing is that's shrinking buyers' down payments, which shrinks their buying power. So, this is something that we watch closely, especially locally in Seattle, because Seattle's such a heavy tech industry that it's something that you guys want to keep your eyes on. I have actually personally been kind of tracking this, and I've seen, we had a sudden uptick in October where we got 50% of our listings pending, and mostly we're in core Seattle. And the reason that I also kind of verified with is I checked all the tech stocks. Those also went up 10% during that time. So the buyers decided to liquidate their stocks and get themselves into a house. So just keep your eyes on the stock market volatility as well, because it does affect what people are when they want to sell their stocks to get into home ownership. So, we want to kind of go over, as we kind of go into a more normalized market, some people are kind of dreading it a little bit. I actually am looking forward to it as an investor. The reason being is I can actually look at these investments in a way that we're supposed to. What can we buy it for? What can we execute and fix it up for? And what can we sell it for? You can really dial in your numbers a little bit better because, over the last year, I think we've all broken some rules of ours. I know I have, where, I prefer to buy specific types of product, and I've been buying all sorts of different ones because I wanted to get into the market. Now, what we're kind of coaching our clients to do, and that we're doing ourselves, is, make sure you're picking the right investment for yourself. Select projects that work best for your systems, because if you're picking projects that work best for your construction systems, they're going to go faster, which is going to allow you to get in and out of the deal. And you're also going to expose yourself to less market corrections. The other pro of slowing down the market is contractor resources. I've already noticed that my construction costs in the last 60 days have dropped 10%. Okay, contractors need work now. They can't keep filling up their pipeline with new projects. Also, with the market kind of slowing down, it is eliminating some newer investors that may not know how to negotiate contractors correctly, and it's allowing them to not get their premium pricing. And then also, the other pros of just a more normalized market, guys, is you can get your investment that you're looking for at a more reasonable term. Sellers don't think they automatically will, have a piece of gold there where they have a very neglected house. So you're going to be able to make smarter decisions on what you want to buy rather than just taking whatever you can get. The cons of, a market slowdown or a market kind of transition is, sometimes when you may have done your performas. I know myself personally, I did performas on projects that I purchased, and as the market corrected, I did not allocate enough time for my holding cost. So we want to tell people, allocate more expenses towards your holding times. So what the holding times, because what it's going to do is it's going to affect your overall net profit. So, if you have a bigger project, maybe instead of factoring 6 to 7 months as your project, maybe factor in 9, because you might need another 2 months of holding costs for the listing time. The longer market times can also slow down the amount of projects you can do in 1 year. How I always look at how I invest in any kind of flip or buy and holds is how much capital do I have on hand, and how can I best put it to work to get me the highest annual cash on cash return. So longer market times and longer hold times on our investments mean less cash it reduces the amount of cash I can deploy out at one time. So really, if I'm not deploying and keeping my cash working as quickly, I need to make sure I'm picking the right project that I'm putting my cash on. And then one of the cons is execution now is key in every investment that we do. The market appreciation is not going to solve poor execution or contractor issues. So putting your right team together is fundamentally important for all investors. We've all had benefit of a slow contractor, and then it appreciates, and then we make more money. Right now, a slow contractor is just going to mean more holding times, and it's going to reduce your net profit. So there's there's less leeway on your construction execution. And then selling concessions, again, we just kind of talked about this. Buyers have way more grounds to negotiate now, and so just make sure you maybe anticipate paying a little bit of concessions in when you go to deploy the assets. So there're just other outside factors now that or other factors that we need to bring back into your performance and projections on your assets. So for 2019, one thing that we really want to address is interest rates and financing. Interest rates and financing will drive purchasing, which is going to drive how quickly our assets are going to be able to be sold on the market. So rates in the last year are definitely on the move. They have upticked from 4% to 4.75%. That doesn't seem like a huge jump. It's a 3/4 point, but it does have big effects on what's happening in the market. So for an example is if someone's qualified to buy a $600,000 house, with the increase in rates, that actually reduces their purchasing power by $57,000. That's roughly a 10% drop. Okay. What makes that so interesting is that's about the exact drop that we saw off peak in the spring. We saw the first 2 quarters have this, with inventories at half month level, they suddenly peaked 10%. And then the pushback on that was going into quarter 3 and 4 is what we saw was that houses that we were selling are all selling about 10% off spring pricing, which is exactly tied to what the interest rates are. So really pay attention to those interest rates. That's going to affect about the percentage rate that your asset may be impacted on. The other thing that, just kind of piggyback on that, again, it goes into also stocks and people's down payments. If we have a borrower that's buying a $600,000 purchase and then they just lost $57,000 or 10% of their borrowing power, and their stock also dropped 20%, it reduces their purchasing power to where that 600 buyer could actually be more of a 500 buyer now. So as you're kind of looking at neighborhoods, really, look at properties that have clusters of comps, because that tells you how much buyers are in the areas. Don't go reaching for that one high comp in the neighborhood, because chances are that buyer pool isn't as strong as you may think. So good. The good thing about interest rates in the first quarter is they're expected to stay very stable. We're expecting them to be about 4.75% throughout quarter 1. So, there's not going to be much of a shift. If interest rates are really that tied into how much homes are selling for, we shouldn't see too much of a pricing shift in the first quarter. In the near future, the Mortgage Bank Association, Freddie Mac, Realtor.com expect mortgage interest rates to rise. They're forecasted to end in 2019 around 5.25%, which is going to be about a half point higher than the second quarter. We're expected to be right around 5% at the end of second quarter. So you just keep your eyes on the interest rate. Our team of professionals at Heaton Dainard are all trained on this. We talk about this in all of our sales meetings. So if you have any questions or anticipations or want to sit down and talk to us, we're more than happy to schedule a meeting with you or a phone call. That's the interest rates on single-family homes. As we go into kind of buy and holds as well, we do sell a lot of multifamily and long-term investments to clients. We want to also reference what's going on with the commercial lending in the 1 to 4 or 2 to 4 unit properties. So good news is on the multifamily and the conventional financing on that is loan limits have increased 10%. So banks will actually lend you 10% more than they were from a year ago. So, that's a huge benefit for us as multifamily pricing has increased. Investors can buy up to 4 properties using conventional financing. That has no anticipated change. And then, conventional financing on multifamily units from 2 to 4, it's an easier underwriting rather than commercial. 30-year fixed rate products. You can still get a 30-year fixed rate product with a low credit score as low as $660,000. If you're thinking about flipping multi-family properties, this is all good information as well, because, a lot of buyers in the market right now are trying to find affordable product. Affordable product also means maybe subsidizing a mortgage with a mother-in-law, an ADU, or a duplex. What that means is buyers with 660 credit score can actually qualify pretty well to purchase that asset next. So those are all good news for either whether you're buying and holding or whether you're looking to sell and flip off duplexes, triplexes, and fourplexes. Once you get above 4 units, the lending changes. There is no really loan limits. I mean, each bank's a little bit different, but how banks kind of lend on is more the debt service cover ratio. Right now, we're anticipated to be at a 1.25 debt service coverage ratio. That means if your debt service coverage ratio is below 1.25, you're going to have to put more money down, or if it's above, you can put less money down, so they don't go up the same requirements of 20% or 25% that Fannie Mae or Freddie Mac may require. Commercial rates are currently around 5.25%. And they're anticipated at 2019 to be about up a quarter point at 5.65%. So not too much of a hike there. You guys, 5.65% on a commercial rate is still a really good rate. A lot of rates were, even 4 or 5 years ago were in the 7 and 8s. So 5.65% is a really good rate for commercial debt. One thing that I also want to kind of focus on a little bit is that DCR, the debt service coverage ratio. One of the most influential things of, keeping your money at the highest and best use is finding the best possible deal on multifamily. That's usually buying something that needs a little bit of work, that you're buying something with some upside in it. Because what you guys can do on this a lot of times is if you buy the right deal that needs the right value add, you can actually leave very little bit of money in these properties if your debt service ratio coverage is covered correctly. So if there's any questions about that, again, feel free to reach out with us and we can kind of sit down and do a kind of a strategy meeting with you about the debt service, commercial limits, and apartment purchasing. So now that we've kind of gone over 2018 and we're kind of forecasting for 2019, what do we do with this information and what we're planning to do in investing in 2019? So one thing, we did send an email out to our client base or a letter back in July kind of talking about evaluating current projects. So in 2019, we purchased a lot of homes in 2018. So as we go forward in 2019, we've had to reevaluate all our current assets. If you have a project going on right now, whether it's through us or another company or investment you found yourself, you really want to work with whatever broker team you're working with to really nail the value of the asset. Make sure the broker team you're working with is going to shoot you the straight answer, because right now you have a very good window to change your scope of work. There's been, currently we have about 50 projects under construction ourselves. We've rescoped out 30% of those projects, whether we increase the scope or decrease the scope based on what the market's telling us. So it's very important that you're running monthly CMAs and figuring out what the trends are going on, because that's going to tell you what kind of specs you need to put in, how high a level of specs you need to put in, and then what your pricing should be at and what the cluster of sales are. What I always tell people, you can't work, if you may have thought your home was worth X amount of dollars in a different market, the market changes and you have to change with it. No matter how much protection and underwriting you do, if the market comes down 10% off peak, you need to adjust your expectations to have your asset sell 10% off peak. And then, one thing that we're really doing is we're pricing out all of our subcontractors and vendors. Again, I've managed to knock off a 10% cost in my construction, and that was through existing projects I was working on, because I had to take the time to educate all my vendors and subcontractors on what's going on in the market, and that we are going back to a set pricing, and if they want to continue working with our volume, that they have to be at this pricing. And I can tell you 90% of our existing subcontractors and vendors have came down to that pricing. In addition to, we're getting tons of more subcontractors and general contractors reaching out to us for work. And so this is a prime time for us to train new vendors, new contractors, our system with our established pricing. So you guys really dig into them. If the market comes down, that's going to impact everybody. It's going to impact investors. It's going to impact mortgage guys. It's going to impact real estate brokers. And it's also going to impact contractors. So make sure they feel that impact with you. As a team, you guys feel it all together. Other things that we're doing is, and I hear this a lot from clients, but, they'll call me and they may have an asset that's not quite selling right because for whatever reason, and they want to keep the house. And what you want to do is go through all your current inventory and figure out which assets work as long-term rentals and which ones don't. The worst thing that you can do, and I did this myself back in 2006 in the first market crash, and by no means are we in a market crash, but I had homes that I had on the market that were pending, and the financing fell through, and I ended up deciding to keep them just based on, hey, I know real estate's good and the market appreciates, and I have this renovated product. That was not a good idea for me. What you want to do is, if you have an asset that you planning on fixing, flipping, and selling, and it's not selling, you want to look at, okay, well, what is my cash flow position and income? If you go to refinance that property, refinance it, how much cash do you have to leave into it, and what's your total income position? If you are not cash flowing, I would say at a minimum 4% on that money, it is not a smart asset to keep. Make sure that you're not leaving too much cash in the deal and that you're getting your return back out. Because what I have found, that even with bad investments, I may sell them at a loss, but I make more money with my capital when I get it back and deploy it back into a rental. I would rather buy a strategic rental purchase where I'm making around a 6 to 7% on an asset that I bought with the intended purpose to keep it as a rental, rather than a flip property that I'm just trying to save a loss on. Just always evaluate all your long and short-term benefits of keeping the property a little bit longer. Maybe it was a quick flip that you may keep for another 6 months on a short-term lease to also eliminate your tax benefits. Then maybe it makes sense to keep it. But if it's a loser, you got to move on. I have a couple houses right now that are, homes I paid $500,000 for, put 100 into them, and they're not selling. And, what I've had to make the decision on is just eat the loss and move on, because it's much better for me to get my cash back and deploy it into a better investment. So don't hang on to it if it's not intended to be a rental, or you're not getting your return that you're desiring out of your minimum expectations. What is our strategy going forward in 2019? The three kind of areas that we focus on with our clients and ourselves is buy and hold and long-term wealth. We're really steering people towards affordable rental product, Pierce County, Snohomish County, or areas in Seattle, core areas that maybe have lower permitting applied for. If you have questions about how much permits are going on in certain neighborhoods, again, feel free to reach out to us. We'll sit down and do a meeting with you guys, and we can kind of show you how much permits are pulled in specific areas. We're tending to stay away from those areas because supplies can be too high. We're also looking for properties as the market cools down. We see a lot of overcorrection from sellers where they start freaking out and giving away a property again. So we're looking for long-term holds with some upside factors, houses on big lots, possibly subdividable, transition areas, areas like Rainier Beach, Tacoma, anywhere that, as we see the path of progress and growth coming towards it, we're really focusing on those areas because those are the holdings that we've done the best on over the 10-year period. There's new opportunity zones where you can get good tax deferment, which we're going to be holding a long-term wealth and buy and hold webinar at the first quarter of January. So look out for that. We'll kind of explain those opportunity zones. And then 1031 exchanges. It's a good time to sell off your peak product and get into a little bit higher income producing ones. Fix and flip, we've made a little bit of subtle changes on our purchases and how we're selling them to our clients or providing them to our clients. We took our target ROI, and this is with no leverage factored in. We took it from a 15% anticipated ROI on a 6-month basis to an 18%. So we want a little bit bigger margins in there for our clients. You guys, there's no reason you should be buying them at the same margins as you were back in the spring because the market's differently. So make sure you're buying a good deal. Larger margins in the properties. The reason we want the larger margins is to accommodate for holding times and just any kind of contractor mishaps. Also, we are expecting larger margins on negative impacted properties. We've all, as the market was so hot and inventory so low, even homes on busy roads, power lines, jetways, they were selling almost at the same value as a normal house. That is not happening anymore. So if you have negative impacts on a property, that doesn't mean don't buy it, but expect a bigger return. Like if I have a house on a busy road and a house that's not on a busy road next to each other, I will buy the one not on a busy road at 18% return, but I may want a 25% return on the busy road house because I need to anticipate for more variances in there. Good neighborhoods, core Seattle neighborhoods, core Tacoma neighborhoods, core Snohomish neighborhoods, those areas actually have been selling very, as long as you execute your plan correctly, the homes sell fast. There's still a really good, strong buyer pool. Good qualified buyers want what they want. Also good neighborhoods kind of factor into getting some kind of novelty product. If you get stuff with a view or good neighborhoods or maybe right next to a Whole Foods or a new development site, those assets sell and they're still selling at a premium. So really look at what's going on around the neighborhoods around you. We talked about this, but budgeting for longer hold times, we're taking our pro forma on cosmetic deals from 5 months and putting them at 6. Our bigger projects we're taking from 7 months and putting them at 9. Narrowing, and then also narrow your comparable data. Dig into your asset, any potential asset you're buying, comps in detail. Just because you may put the same upgrades in a house doesn't mean they're worth the same. So make sure that the products match up very similarly. We're also starting to add in 5% contingencies in all of our budgets for our clients and ourselves just to cover any kind of contractor mishaps because appreciation is not going to do that for them. And then what we're doing and we're telling our clients to do is create your buy box and stick to it, right? You have your team put together that can execute assets in a certain fashion. Focus on those assets. Don't go, just because, in the very beginning of the year, we were all just looking for deals. So we were buying all sorts of deals that might not have fit into our systems quite that well. Figure out what the best, look back at your projects, what worked best for you, what was the most systemized, and then create your buy box and stick to that box. Don't break your own rules because that's going to end up costing you money. And acquisition strategy, what we're doing for our builders is we are trying to get every property to close on permits to reduce holding times. Again, appreciation isn't going to save the cost of the financing while you're waiting on your permits. So we're trying to get closing on permits. And that's also going for the big fix and flips. If we can get the right term from a seller, we're trying to get our permit applied for before we actually close on it. Other areas that we're still focusing on is infill areas in Seattle. As sellers start to get worried, people selling dirt getting worried, they're doing some overcorrections right now, and they're actually dirt is usually the first thing that gets overcorrected. And so we're starting to see some very good pricing in neighborhoods we hadn't seen in the last 24 months. Also, we're going for seller carrybacks to reduce carrying costs and financing expense. And again, we're telling our builders, stick to your buy box. If you're an infill city guy, build stuff in city. If you're an east side builder, build it in the east side. If you're a track home guy in Kent, that's what you should stick to. Don't start jumping markets that you may not have systems set up for. Our renovation strategy on the fix and flips and just any kind of development is, what we're kind of doing an evaluation on and really coaching our clients through is the design. So in 2019, for all of our clients, we're rolling out our new flip books, which is going to be, they're very cool. We're coming out with about 16 different versions. The reason we want to do this is because, as homes get designed, a lot of investors seem to just follow the same trends. What we want to do is make sure that our clients' homes all have their own kind of uniqueness to them. Template flips are actually not selling as well as certain types of assets. Buyers want to find something special now, and they can be a little bit more picky. So design is very key. Again, look out for those flip books that we're rolling out. Again, I think actually we have close to 20 different versions for you guys with different budget pricing and designs in them. Uniqueness. Work with your broker and find out that special little thing that you can do for a very low cost. You can add some extra flavor in, whether it's some shiplap paneling in your house or maybe a custom little design mantle. You want buyers to make, as inventory's up and they have more choices, you want them to pick yours. So give them that little extra umph. Again, our brokers at Heaton Dainard are trained in these things, and we know how to do them for a very slim budget. So, if you have a current project with us, call your broker. They'll walk out with you. They'll give you some designs, ideas, and budgets on them. Pre-inspections. We highly recommend that everyone gets, after they're done with the renovation, get your home pre-inspected. You don't want to get beat up on your inspection. If you get beat up on your inspection too much, it's going to really affect your net profit. If you're anticipating a $30,000 to $35,000 profit and your inspection comes back bad, they can beat you up for around $5,000, which can be about 20% of your net gain on the year. Contractors and vendor negotiations. We talked about this a little bit earlier. It is a prime time to beat up your contractors and vendors. Everyone has experienced this massive price increase over the last 12 months. That is no longer happening. I know as an investor, I'm not putting up with it. Meet with your team, meet with your tradespeople, go over budgeting, and as a team, work on your pricing, and get your costs down. It's very, very capable and doable right now. If you have guys that are overcharging it, call more. People need work right now. And then also, don't just overspend. Budgeting is key in the execution of how you make money in real estate. Appreciation is not going to clean up your mistakes anymore. The whole attitude, and I've seen this a lot with investors over the last 24 months, is, we're just going to make it nicer and someone will pay me more. And that honestly was true in the last 24 months. That is beginning to change. So what, making your home nice will get you is getting your home sold first, which is going to reduce your holding times. But that doesn't mean you should overspend your asset and overspend all your profit. If you're running into budget problems, again, reach out to your team, reach out to your broker, and really lean on them and depend on them to help you get that number back down. And then finally, slow contractors. We all have them. I have my guys. They're cheap. Some of my guys are cheap. I've known them for a long time, but they're slow. So they got to go. Slow means negative returns. If you have your cheap guy, but they can't figure out how to systemize it, either give them less scope of work or just move on from them. The holding times are going to kill you on any investment. As far as what our strategy is for disposition of assets or listing properties, what we're telling all of our sellers, what I'm doing personally on all of my homes, like currently guys right now, I have 12 of my own houses for sale. I think 7 are pending. So, one thing that I've noticed, that the ones that go pending quickly, is me not pushing the price. What you want to do is, again, you got to forget about what you thought you may have sold it for, and you need to sell it in the now. Look at the cluster of comps in whatever is going on in that neighborhood. That's going to tell you where your buyer pool is. If you have one random comp in the middle of nowhere, close to you, but it's 10% higher than all the cluster, most likely your home is not going to sell for that premium. Stick with the cluster. What that does is it gets activity and gets people to make a decision quicker. If you have an asset price at everything else that's a little bit nicer than the competition, you're going to sell first. Evaluate the competitive and comparables. Really dig into all your comparables. Again, just because you upgraded your home and put new cabinets in, new counters in, new flooring and new design, doesn't mean it's worth the same as the house that was also updated. You got to look at floor plan. You got to look at parking. You got to look at neighbors. All these outside effects will really slow down your sale. I had a house in Kirkland where one of my clients' homes was listed for $700,000, less than a tenth of a mile from my house. We sold his house for 8% more than I sold my house for. The reason is I had a really bad neighbor next to mine. They were identical houses with identical remodels. So really know what your competition is and of your comparables. Pre-inspections, again, we talked about this. Make sure you get your properties pre-inspected, guys. There's nothing worse than having a contractor's punch list kill your sale. So just make sure your home doesn't have these weird overlooked items on it. And then patience. Work with your broker, find out the showing activity, and wait for that buyer to come in. Again, buyers right now, which they should have the right to, is they want to pick the home they want to live in for the next 5 years. They haven't had that right the last 24 months. So they're going to take their time, be patient. If your showing volume's down, it's a good idea to cut your price. But if your showing volume is steady, you just got to wait for that person. So work with your professional and work with their advice. That's what they're trained to do. So as 2019 kind of rolls in. I know personally what we've been doing is we are going to go from doing 130 flips a year, and we're going to try to take it back to about 75 to 80, just so we can be a little bit more efficient in our construction process, not because we don't like buying flip properties, but we know appreciation is not going to fix our inefficiencies. The other place that we are suggesting everyone to really open their eyes to is real estate holdings. What real estate holdings does more than just offer you a steady return is it helps with economic uncertainty in volatile markets. So things that we kind of reference on this is the stock market, it also is down 8.5% from peak, which is very, very similar to real estate, right? In a peak correction where that really hurts investors is when they're only in fix and flips. If you're in a buy and hold and you have steady income coming in or residual income coming in, it may affect your rents a little bit, but if you have the right rented product in affordable areas, it's really not going to adjust. So that 8.5% decrease across the board in real estate or stocks is not going to affect your net return. What Goldman Sachs is actually anticipating the S&P to rise for is a 5% gain by the year of 2019. Okay, so what that means is if real estate historically is growing at a 5% rate and the stock market is anticipated to be at a 5% rate, real estate usually will prove to be a better controllable asset for you guys. You're going to be able to control your rent yourself, control your vacancies yourself. If you're not in a heavy tech-owned area or maybe core areas in Seattle where rents are starting to climb to $3 and $4 a square foot, your rents aren't going to adjust that much. Right now in a lot of neighborhoods, rents are still affordable for people, especially compared to mortgage rates. And things that even with companies like Goldman Sachs anticipating a 5% over time over the stock market, things that also are that they can't anticipate for, just like real estate can't anticipate for sudden interest rate impact changes, is things that are going on in the economy right now are the trade wars. If the trade war, if China and the U.S. can't figure out the differences and get on the same page, that's gonna very negatively affect the stock market, and the 5% growth could be very, very minimum, if not negative. Also, right now, stocks are not completely. A lot of heavy tech stocks where people have done very, very well in are overvalued per their financials. So if you are kind of leaning towards, stock, traditional investments, or real estate, really look at the stocks you're buying and the value of them. Because what we believe is in real estate, like what we talked about, was that it's a controllable investment. I like owning an asset that I can control who rents it, what happens to it, when it gets sold. Whether it's, if I'm in the stock market, I am completely dependent on a different company and what they're doing financially. Also, I don't like that I can't control certain outside factors like trade wars, overvalued stocks, things that can cause sudden big corrections. The other reason real estate that we invest a lot in real estate is it gives me a steady yield. If I'm going in and there's an apartment building right now I'm looking at in Pierce County, and I'm anticipating a 7% yield on very affordable rents. I know if the stock market's anticipating a 5% growth and that real estate gets a 5% appreciation on average, but I can bank on my 7% yield. I can budget that into my investment goals at the end of the year. So it gives me a very steady, consistent income that I can anticipate. And then in real estate, I like that there's less impact from outside factors. Yes, economic downturn can cause interest rates to rise or fall, but as long as I'm purchasing the right assets in the right affordable neighborhoods with the right upside, the factors don't really matter. Whether the stock market goes down 10%, it's not going to affect my renter in Tacoma that pays me $900 a month in rent. So I like that there's less outside factors and I can control the asset a little bit more. So you guys, there's a lot of benefits to real estate holdings outside of the steady yield, the controllable assets, and the less impact on the factors. Again, we have our long-term wealth seminar and webinars coming out at the first quarter of January. We're going to talk about all these things and the impacts that investing in real estate can do can provide you with over a long-term basis. Also, there's some really cool tax benefit things going on in specific neighborhoods that can save you a ton of capital gains over the next 20 years. So we're going to talk about all those things, but this is all why, as professional investors, that we're investing in real estate. That doesn't mean that you shouldn't diversify and look at other things to invest in, but real estate will give you that steady, consistent yield. So as we kind of wrap up, I just want to say thanks for everybody for kind of coming out. What we're going to do now is kind of open it up for any kind of questions that people may have. What you want to do is just kind of go into that little chat box that you may see on your screen. All you have to do is just type in your question, and then we will answer them. I'm going to answer them for topics that, we might go a little bit over. I'll answer them until you guys are done asking questions, and then from there, if for some reason any of your friends could not attend this webinar, it will be on our website by tomorrow. You can feel free to share it with everyone. Also, we have our fix and flip cash flow class and our buy and hold class. It's free every other Monday at our office. It's about an hour presentation. We don't try to sell you anything. It's just about how we do our processes and how we evaluate assets. Come by and see us. And for up-to-date schedule on that, go to HeatonDainard.com. So I'm going to open it up for questions now. If you guys have any questions about our opinions on what's going to happen in 2019, feel free to ask. All right, we have some questions coming in. One of the questions is, will this be on replay, James? Yes, it will be. It's on the website, HeatonDainard.com. You guys can download it at any time. Another question is, are you seeing a lot of development in Seattle market that is permit ready? We are starting to negotiate all sellers with permits on development properties. I mean, you guys, if it's a really good deal, if we're picking up the dirt, let's say the lot's worth $250 and we're getting it for $100, no, we're probably not asking for permits. It's all based on the discount and the performance. But yes, sellers will, what we've trained our kind of sales team to do is when they're working with sellers, if they want a high price, they got to give us the terms. So yes, we are trying to close with permits when we're working with sellers. Another question, is there a percent of the amount sold original list price or list price? Hold on one sec. Sorry, guys, there's a lot of questions coming in. I'm trying to keep up with them. It says, is there a percent amount sold of original listed price or the listed price at the time it was sold? That's at the time it was sold, Tim. And we got all these stats from the Northwest MLS, but that was not of original list price. That's a very good question. Actually, I want to figure out that answer, so we're going to dig into that answer, and then we'll load it in a blog on HeatonDainard.com. So if you guys, next 24 hours, I'll get you that answer. Another question is, what areas do you see being hot for areas for 2019? Very good question. So you guys, there's some really cool tax benefit areas, depending on what you qualify as hot areas. For fix and flip, is going to be a lot different than buy and hold. So for fix and flip, the areas that I do really like to focus on still personally is those core Seattle neighborhoods. Whether it's Ballard or Wallingford, University District, because the buyer pool, that's where they want to live, and it's more for walkability and location than anything else. And if you want to be in a good neighborhood in a good location in Seattle, you still got to pay the money for it. As long as the home is completed correctly, people are still paying, market value on them. So good neighborhoods with good qualified buyers. Other things for flip properties, that I like is I like a target resale of under $350 in South King County. It's really more based on qualified buyers. I'm seeing I like affordable product in kind of the South King County area, in Pierce County. Again, I like to be a target resale of $299 or less because that stuff sells still really quickly. Affordability, guys, still sells very, very fast. So, affordable is good, or core good neighborhoods. We just had a house in in North Everett, a good pocket right off Hoyt. It's just a desired area. We've actually seen one of our clients that bought a home in the spring at peak where we had a value at 450 on. The home's actually worth 10% above peak in the spring because the neighborhood's so good and inventory so low. So, good neighborhoods, good neighbors, that's kind of where you want to be at. As far as areas I see being hot is for buy and hold. There's a lot of new opportunity zones where you can get a tax benefit and defer, or basically you can be capital gains free after a 10-year period. So the return is huge if you hold the asset longer than 10 years. But areas that I've always liked is Renton, Seward Park, anywhere on the outskirts of the last pop. So, for example, Del Ridge went up at an astronomical rate over the last 24 months. I think it probably appreciated about 35 to 40%. What this did is it brought White Center up 20%. So the next pocket after that we're seeing a lot of, kind of pull up on is like Rainier Beach. That's kind of the next area. Same with North Tacoma. North Tacoma has appreciated at 20 to 25% rate in a lot of neighborhoods. And so what that's doing is the north end of South Tacoma, just south of 6th Street, is now starting to jump up. So look for those areas that appreciated the highest and then backtrack the neighborhoods down from there. And again, you guys are sales teams are trained on this stuff. So if you guys want to sit down and do a one-on-one, we're more than happy to go over where the opportunity zone maps are and other kind of hot pocket areas. Another question is on those stats, you should for each county is what I'm referring to. Okay, yeah. So one of our clients attendees is asking us to kind of break down these stats for each county. Again, you guys will post this on a blog in the next 24 hours for you. So just go on the Heaton Dainard blog and I'll get you that answer. One of our clients is asking thoughts about Kitsap market, buy and hold market, or long-term holdings in Kitsap. Kitsap County and Thurston County are always going to give you a high yield. What they're going to give you is a lower appreciation. And personally, I like the yield at Kitsap. Usually you can get stuff in Kitsap Thurston for at least an 8 cap, which is a good earning position. It really is more, we push our clients that way if it's about balancing their portfolio. They may have a lot of appreciating assets in their portfolio, and we kind of look at it and we think they need to create more cash flow, so we'll push them into Pierce, Kitsap, and Thurston. They're all good markets. Rents are really affordable. I don't see too much of a rent increase there, though. There hasn't been that much in the last year. But what we will do too is on the blog, we will break down the same data and facts that we went over Kingstone and Pierce and put them on the blog as well on Kitsap County. Another question. So do you see home prices go up or down overall in Linwood area? Good question. We have quite a bit of listings in Linwood. So what I've seen is in Linwood, homes are selling 10% off spring pricing, at the beginning of the spring. Ones that were most impacted in Linwood are the smaller homes. We were seeing homes that were 3 bedrooms, 1 bath, like under 1,100 square feet, get bid up into the 500 range. They were selling for about $550 a square foot. Those are all selling it for about $475 a square foot now. It's very consistent in most neighborhoods all the way through Linwood. The bigger homes have taken less of an impact because it was more about affordability. So homes that are around 2,000 square feet that allow for more family growth and a long-term kind of play out with their overall life, those were affected more 5 to 7% off of kind of the area. One thing about Linwood, though, they do have some kind of weird neighborhoods in there and some weird tucked-through streets. There's a lot of little rural nook and crannies, especially where it runs into Bothell. Those areas, because the overall neighborhoods and just the topography of the area, those we've seen a little bit. They're a little bit stranger products, so I've seen about 10 to 15% drops in those specific areas. If you have a question about a specific house, feel free to email it into us, and I'd be happy to kind of give you a CMA on it as well. And another question is your cost a square foot? What is your cost per square foot on cosmetic rehab versus studs out on average? Okay, so that's a very good question. It's a little bit of a varied question because it really depends on size of house. If I am at a studs out house, why don't we break it down more by square footage? So if I'm at a studs down house, it's around 1,000 to 1,500 square feet, and I'm talking about like a full rebuild back out. Usually that costs me about $80 a square foot on a small house. That's at 80 to 90 bucks a square foot. On a larger house, let's say this 2,000 square feet above on a studs down, it costs me about 65 to 70 bucks a square foot to studs it down and put it back together. Now that's going to give me like a flip standard style house. That's nothing custom in there. Cabinets are going to be where we all kind of get them from. If you don't get them from Pius, you should check them out. Great company. So for the studs down, about 60 for big ones per square foot, and then 80 bucks for the smaller ones. My cosmetic renovation, that's again, if we're not doing counters, it depends also on appliances, HVAC, furnace change out. But if it's just in and out without any kind of mechanical upgrades, it costs me about 20 bucks a square foot. Cosmetic rehabs are more about the plan and the strategy than the actual rehab. But very, very good question, guys. But you guys, again, beat your guys down 10%, whatever you were paying. And if you overpaid last year, whatever you were supposed to pay, it should be 10% below that. So another question. Will you be doing a webinar on how to do an accurate comparable? Oh yeah, we are going to be doing that out. So our schedule for our webinars is, you guys, we're doing a long-term wealth and how, and part of that we'll be doing an accurate comparable on buy and hold properties and how to evaluate them on income and on comparables. What the next, so that's going to be a 4-part series breaking down different opportunity zone neighborhoods, 1031 exchanges, portfolio strategy for your own investing. But what we're going to do after that 4-part series is just an investor toolkit. And part of that will be on, yes, how to look at comparables, how to break them down, things that we look at. And you guys, that's not saying that how we do it is 100% the right way, but that's how we do it every time we're buying a home. And it's worked out very well for me over the last 13 years. So yes, we will be kind of doing that. That's a good question. Check for our blog or get on our email list. You'll get an update on when that will happen. And if I can't get to it any sooner, what we will do is we'll try to do a blog on how we break down and analyze our properties. Another question, do you consider West Seattle, west of 35th, the core area of Seattle? I guess it depends on the investor and what neighborhood they like. I do. I think West Seattle is a great market. You have to be, I would say that I don't really classify it as core, because core means that to me, means it kind of appeals more to the masses. West Seattle is this cool, awesome area that really gets a specific clientele that want to live there, including myself. If I live in Seattle, West Seattle will be one of those neighborhoods I like. But, because of the commute there, you're looking for kind of more specific buyer. A lot of times you're not going to get those commute-heavy buyers in that area, but they want it for the walkability, the location, the overall feel, what they've done with the development of the downtown. So I do consider it a very strong market, and I would classify it as the core. I classify core basically from Hillman City to Shoreline, or not to Shoreline, excuse me, to the start of the start of Olympic Hills. That's kind of my core, but West Seattle is a very good area in general. A question is, how do we get on your email list? You actually just go to www.heatondainard.com and you sign up, and then we'll get you approved on there. And you guys, we're trying to get a lot of educational stuff out via our email. We're trying to not send you out as much marketing gimmicks for you guys. We're really focusing on educating and teaching for the next year. Again, it's all free education. Our goal is to help investors be as successful as possible. Successful investors mean successful businesses, because those are successful clients. So, look for the education, and then also check the blog. One other thing that we're starting to do for 2019, I forgot to reference, is we're starting a client Facebook page. It's only for clients that have purchased or sold through us. what it's going to be having is we want clients to kind of put on their sale items where they're getting good deals on materials. And then we're going to, our team is going to be constantly posting updates. Like there might be a sale on appliances where you can get a full set for $1,500. We're going to make sure that our clients are aware of all these sales. And the more people contribute, the better. So if you're a client, you will be getting an invite to the Heaton Dainard private Facebook. If you're not a client, I'm sorry, you're not welcome, but you can become one and we'll get you right in. But again, it's just about flips and tips on this one. All the webinar stuff, though, is welcome for everyone, guys. Another question we have is, what do you guys think about Normandy Park area? Great neighborhood, but close to the airport. Normandy Park, you know, for South King County is just one of those, I mean, that is one of the upper echelon neighborhoods. What I have seen in Normandy Park is a lot of pushback on pricing because, you know, the interest rates have affected that area quite a bit. Because a lot of your really qualified buyers or tech buyers that are driving a lot of the higher end sales, they want to be closer to their jobs and commute. Normandy Park is really a lot of the Burien transition, you know, like Burien, Des Moines, you know, transition buyers where they want to get their kids into better schools, a little bit better areas. So they're going to be more impacted on what they're selling their home for in the transition. And also that, you know, as interest rates have increased, they're less stock option heavy for their down payment. They're just building it more on savings. So, you know, the increase in rate makes a big difference. And if you're medium, you know, in Normandy Park, a lot of the stuff, if it doesn't have a view or waterfront, a lot of the sale pricing is, you know, it's $550 to $700. What I've seen is that the $550 to $599 range is selling really well, and usually that's going to get you a 1,700 square foot to 2,500 square foot house because people can upgrade their quality of living in schools and neighborhoods without killing their financial budget. But that same range from 550 to 600 had people qualified from 650 to 700. And so that's where we're seeing a lot of drag down in those kind of neighborhoods, you know, where the tech heavy people, they can't sell up their stock to put the bigger down payment on. The people just can't afford to put the bigger down payment down. So there's just less buyers there. So buyers are a little bit more picky. Okay. Any more questions, guys? We're getting a little bit past our time, so feel free to ask more questions. We have another one. And you guys feel free to ask away. Just because we're running over on time, doesn't mean I'll stay around and answer as many questions as you want. But once the questions die off, I'll be cutting out. Another question: do you see Highland Park as better than Upper Rainier Beach? I think Highland Park has already hit a little bit higher appreciation rip than Rainier Beach. I think Rainier Beach has a little bit more upside. That's a good question. I actually study both neighborhoods quite heavily. I would say that the reason I like Rainier Beach a little bit more over Highland Park is the average price per square foot is a lot lower on any of the assets being sold. They're very relative locations. The big difference is Highland Park has a little bit more development going on in there, so they have a little bit more, you know, it's a little bit more walkable than Rainier Beach. Rainier Beach is kind of in its own area. But, you know, if I'm buying a house, you know, on the bigger homes, you can still find a 2,500 square foot value at home for under $200 a square foot in Rainier Beach, where you really can't Highland Park. So, you know, that's why I will tend more towards Rainier Beach as far as a longer term asset. I think that your demographics of renters and buyers are very similar, so you can just kind of pick up, you know, a little bit more upside in the asset. Here's another question. James, you said something about holding a rental for 10 years and not for capital gains and tax benefits. Not sure if I understood that. Okay, so you guys, what that is actually regarding to, and this is that webinar, the long-term wealth webinar that we're rolling out in January. What this is regarding to is that, you know, there's a tax code that was released this year. It's about opportunity zones. And, you know, there's been a couple things that have happened over the last 50 years. One big thing that's happened is there is a lot of 1031 and deferred earnings sitting right now. So what the federal government has actually done is they've incentivized investors to pay their tax, and instead of deferring their earnings for, you know, 30 to 40 years, what you would do is on the capital gains, whether you're selling stocks or a property, you can actually defer that gain, like a 1031 exchange, into a new area, which it has to be inside this opportunity zone. Inside that opportunity zone, what is you defer all your gains, and then in 10 years you're going to pay your tax on that gain. And what it is, I think it's, you guys don't quote me on this exactly. We're going to have again the webinar with the exact details on it, but you pay 10% less of whatever the current capital gains is at the time. So if you're deferring $300,000 of capital gains, you're going to pay the capital gains tax on that in 10 years on that deferment. The difference is when you instead of a 1031 where you're always deferring, is at the end of that 10 year you pay that tax. The rest of that building is 100% tax free in that opportunity zone for the rest of its life. So you're paying your tax at the 10-year mark, but all appreciation, income, everything else out there is not taxed at a high capital gain. So it's got a lot of upside in it. It's really, you do have to budget correctly in your own portfolio. If you're deferring a lot of your gains and you're not liquid enough to pay that, you got to kind of budget in to pay for that tax bill in 10 years. But the fact that you can grow your money tax free and pay your tax on what you've already realized in a 10-year time in an area with upside, what that's going to get you is high appreciation. So your asset's going to, appreciate at a higher value because it's an area that they targeted, they want developed, they want improved, and you get to do it tax free. So it's kind of a no-brainer at that point. And you guys, we have a broker at our office that's specialized, trained in this, and she's working with our clients right now at finding those. If you're interested in that and you want to sit down and do a one-on-one appointment with us, feel free to reach out. The broker's Jennifer Hafner. She's been handling all of our multifamily acquisitions for myself and for our clients. We're more than happy to have a sit-down meeting with you about it, kind of explain it. But very good question. Any more questions, guys? Well, thank you guys for logging on. We really appreciate it. You guys tell your friends about it, because honestly, my favorite part of these webinars is the questions and answers. I think questions and having investors all working together and having good dialogue is the most important thing we can all do. So again, let your friends know about it. You can send it out to them. Again, it's all free, and we look forward to the webinar series that we're going to be launching in 2019. One thing, if you guys could help us out with, we're going to be sending out a survey. If you could fill it out, we just want to know what we can improve on, what you guys want to know about. The survey will also kind of help us schedule what webinars to put out. So get us that information back, and we'll try to get you as much information as we can. So thank you, and I hope you guys all have a happy holidays, and we look forward to 2019.